Hello everyone, my name is Anuj. Welcome back to the channel. I'm trying to start a video series wherein I'll be explaining the basics of futures and options. I've seen a lot of people don't really know what it is or how to use them, even though they're trading in the equity markets. And although it's a little risky, you can always tend to a few instruments or ways where you can make money with a little risk, where you won't be facing an unlimited loss like in selling. I try to make it as simple as possible while explaining these basic concepts. And yeah, I hope you guys like it.
So what I've observed is that a lot of the people in our country either know about the equity segment or ETFs, the mutual funds, or the bonds in our country. And a very few people in our country, a very small percentage, I would say, would know about the futures and options market. This is probably due to a certain risk that comes in this segment that you would not see in the equity market. So, in an equity market, the max loss that you would be susceptible to would be the investment amount that you have made. But in the F&O segment, you can make a loss bigger than your investment amount. I think that is why people stick to the equity market. It's the risk factor that comes in the F&O segment. But I think it's just a misconception that people have built in themselves after looking at extreme situations or looking at someone who has traded without proper information and has lost a lot of money. People don't see that there are a lot of advantages that the F&O segment gives the traders, and it is a very underrated segment, to be very honest. So I think the options and the futures market provides you with that opportunity that the stock market or basically the equity market does not. In this series of videos, I'll try to break a few misconceptions and I will try to show you how you can use the market with low amounts of risk and utilize it as efficiently as possible for your risk appetite. So first things first, what is the F&O segment used for and why was it created? Initially, this segment was created for farmers and wholesalers to reduce their risk in their markets. Later on, it was seen as an investment or speculation tool for traders in the markets. So, let me just give you an example of how this works traditionally. So, let's just say these are the farmers and this is the company, right? So, basically, the farmers need to sell their crop and the company needs to buy their crop from the farmers, right? To produce goods. Now, let's say this company produces cereals, right? So, if this company produces cereals, you must notice that every year, round the year, generally the prices of this cereal is fixed, right? You don't see a variation in these prices. How do they manage that if every year and every time the crops change their prices, right? There is a fluctuation in the market every time. The prices of these commodities go up and down according to market conditions, right? Then how is it that these prices that the company sells at, generally the goods, how do they always stay at the same price no matter what happens in these markets? So we'll see that now. So no one wants to really take a risk, right? So basically, the farmer wants to sell, let's say, at X price, a certain quantity that he has. He makes a futures contract at X price, as in they both come up to a certain price that they both are okay with, and then they make a contract, right, for a certain proportion. Let's say at X quantity, this price is sold, and at X quantity, this price is bought, right? Now, why is this done? Now, let's say that at a later date, there is a lot of harvest, right? A lot of farmers harvest at the same time, so that could send the prices crashing down, right? So, what happens in this case is that since the farmer has made this contract at this price, no matter how low this price goes to, below X, he will still be selling this quantity at this price, but this would result in this company making a slight loss. But even he has taken only X quantity. He has not taken all of his quantity at this X price, right? In the other scenario, where there is a drought or some other circumstances due to which the prices go high, right? It goes above X. In this case, the farmer is going to make a loss on this, but the company is going to make a profit on this X quantity because the market price of the crop has gone higher. So this process of basically having a set price no matter what the market does is called hedging. It is protecting your money no matter what the future prices are, right? So no matter what happens in the future, no matter what are the conditions, Neither the farmer nor the company has to be very anxious about it. They can have a calm mind because of this futures contract. Now that we've seen how the farmers and the wholesalers used to use it back in the day, we will now see how the traders use it in today's market. So before going to the depths of that, let me just explain to you what a spot chart is and what a futures chart is, right? So the spot chart of Nifty would be this, the basic chart of Nifty that we can see as an indice. So this is the spot chart of Nifty of what is actually happening. But this is not the same as the chart of the Nifty future, right? Nifty futures are available here, like Feb future, March future, and April future. So the price that's trading here is slightly different, not very different, but slightly different to what it was at the spot chart, right? The spot is at 17,604, while the future is at 17,687. So let's say that this is the Nifty spot and the future is trading at a higher price than that of the spot, right? It is trading at a higher price. So this is when we say that the future is trading at a premium, and the traders, maximum of the traders expect that the markets will head higher at a future date. And the vice versa case would be that it is trading at a discount, which is lower than that of the spot price. In this case, the traders feel that the market will go lower at a future date. So the futures market is actually quite similar to that of the equity market, except for a few tweaks here and there. I will further discuss on how to use these tweaks for your advantage if you have proper knowledge in the instrument. So the first difference between futures and equity. Why do people even trade futures, right? It's more or less the same. Like if you see, Reliance is trading at 2,329 over here, and the Reliance future is trading at 2,343, which is expensive, right? But a very minor difference nonetheless. Now, why do people actually go for the future, right? So, for that, I'll have to go to the zero the margin calculator. Over here, you just have to choose NFO for futures and options, the futures category, and let me see Reliance February future. Right now, once I add this, you will see that at 250 quantity, I just pay 1,07,837 rupees. Whereas if I have to actually buy 250 shares of Reliance, it would cost me far more, right? It would cost me, let's say, 2,300 into 250. It would actually cost me more than 5 lakhs, right? So that's one of the biggest differences in equity and futures. So basically, let's say I have 5 lakhs worth of cash with me, and let's say I want to take up a position in Reliance wherein I want to buy 250 quantity, right? Now, why would I put in all 5 lakhs into this if I can just pay 1 lakh and hold the same thing, right? So that's how people use futures instead of equity, using money smartly. You can use the other money that's left, basically 5.5 lakhs, whatever that you have left, to invest elsewhere or to invest in a more secure place where you don't need to really worry about it. But one also needs to be cautious here, because it's not always a gain over here, right? Because some people, what they assume is that they would be trading at 1,07,000 and they have 1,07,000, so they can buy this lot, but they are not looking at the risk, right? If the stock falls 20%, they would be losing 100% of their capital. In reality, the loss would be more than a lakh, right? Because you are not trading 1,07,000. This is only the margin that is required. In reality, what you are trading is 5,75,000, right? Like we calculated 250 into 2,300, let's just say. So you really need to be very careful while trading this instrument. But also, it goes the other way too. What people see is only the upside, but what you really need to see in the stock market is how much you can lose rather than how much you can make. So what's the second difference? The second difference is that there is an expiry to each future contract. So we learned that the future is basically a contract, right? So every contract has an expiry date. So what happens here is that every month, let's say Feb and then March and then April, there is an expiry to these futures, right? So when do they expire? They expire on the last Thursday of every month, and if the last Thursday of every month is a holiday, then they will expire on Wednesday, right? So now you tell me, how is this an investment, Anuj, if it expires, right? If this value is going to go to nil or basically have no value at the end, at the last Thursday of the month, how is this an investment? This is like a short term trade, right? But that's not how it works. So basically, what happens is when you trade the Feb future towards the end, on the last Thursday of this month, that would be 23rd of February, what you would do, not the very last day, you would do it like 2 or 3 days prior to this, because you could also have liquidity issues towards the end. So what people do is on 21st or 20th of February, what they would do is they would square off the position over here. They would basically sell the future that they have bought or buy back the future that they have sold, and they would shift it to the March future. This process is called rolling the future. While rolling the future, you would have to pay a very small price as brokerage, and they would roll the future forward, right? This is a very small price to pay if you are using only 1 lakh out of the 5 lakhs capital that you initially intended to invest. And if you are putting the 4 lakhs in some place, that gives you a good interest of a minimum interest even of 5%. Say you are putting it in an FD, right? So this is a very small price to pay in that case. But there is a downside to this expiry too. Now let's say that you forget to square off the position, which is always a possibility, right? So let's say that you forget to square off at the end of Feb. Now this contract will be executed, right? This contract is now executed, as in you will have to actually take delivery of the 250 shares that you had originally placed. So basically now your margin from 1,07,000 has basically gone to 5.75 lakhs, right? So basically you have to take the delivery of these shares in reality instead of it being just a contract. So for people who go to jobs, this might be a sort of hassle if they forget to square off this position. And sometimes if you wait too long, like if I wait till the very last day of the expiry, I might not even get an exit. So that is why people square off 2 to 3 days before the actual expiry. Usually you don't see this being an issue in any of the Nifty 50 stocks that we have. Nifty 50 is basically India's top 50 companies ka index, right? So usually we don't have an issue in these stocks. So one thing to note over here is that a stock and a future are two different things. As in, you won't get the same benefits as you get in a stock in a future either. Like you won't get the benefits of dividends or splits that happen in the stock, right? You only get to capture the up moves and the down moves in the stock. You won't get any of these benefits. Although a lot of these companies that are listed in the F&O segment do not give significant dividends, I would say. Like Reliance does not give dividend every year, and neither does Tata Motors, and TCS and Infosys, they give very minor dividends. But what matters are the stock splits that happen sometimes. You won't be getting those advantages in the F&O segment. You will only be getting the percentage difference in the investment amounts, and to capture large moves, you will need to invest lesser than required. So moving on to the third difference, which is holding a short position for more than one day, right? In the equity market, you can only hold the short position for one day. You cannot carry it to the next day. You have to square it off on this day and book your profits. Whereas in the F&O market, you can carry your short position until expiry, right? You can carry it for 1, 2, 3, 4 days, depending on when or which expiry you have basically chosen. So what is a short position? In almost no other industry, you can sell something that you do not really own. In the stock market, you can go ahead and sell a stock you don't own and buy it back from the market itself. So how does this work? So as we know, we have brokers in our market that we use to trade. So what we do is we borrow a certain pair of shares from the brokers. Let's say I borrowed 3 shares of Reliance, right? I borrow 3 shares of Reliance at the rate of 200 and I sell it at market price. Basically, I sell it at 2300 itself because I think that the price will go down. Now, let's say the price actually goes down and the price is now at 2200, right? The difference is 100 rupees. And since I have 3 shares, I make a profit of 300 rupees. So what have I done? I've borrowed the shares from the broker. I've sold it to someone in the market and then waited for the price to go down, right? And then once the price is down, I've bought back the shares at 2200 rupees and I've given it back to the broker, right? So this is basically the vice versa way of actually buying the stock. At this, when you're buying a stock, what do? You go to the market, you buy the stock at say 100 rupees and then wait for the price to go up and then you sell it at say 150 rupees. Now this difference is your profit, right? But when you're selling the share, it's vice versa. Here you are selling the share at 150 rupees to someone and then you are buying back at about 100 rupees. Now, you just have to give back the shares to the broker. It doesn't matter at what value they are at that point, right? So that is why you make a profit of about 50 rupees here and you make a profit of about 50 rupees here by buying, you make a profit of about 15 rupees over here by selling. So this is what we call shorting the markets. If you've not watched the movie already, there's this movie called as The Big Short. You can watch that. It explains exactly what they had done during the 2008 financial crisis. Now that we know the advantage of shorting the market, that you can basically make money no matter where the market is going. While going up, you can buy, and while going down, we can sell, right? But there's a risk related to selling, right? Now, when you buy a stock at 100 rupees, you know that the maximum loss that you can incur is 100 rupees, right? Because it cannot go below 100 rupees. A stock price can never be in a negative value, right? Now, but that in the selling position becomes the opposite, right? Because you know that your max risk is now infinity, right? Because no matter what, you can't really predict the markets. Your stock, you know, will go max to zero, but you don't know to what extent it can increase, right? So that is why selling has that extra risk involved. With this, we are at the end of the video and I hope you found this video very helpful, and I have tried to impart everything that I know about the futures markets, and I will try and upload more videos about the futures and options market. I'm trying to make a series of videos where I will be explaining all the concepts about options as well, but options isn't as easy as futures because futures is more or less like equity. Options we have a lot of other factors that influence the prices of the option premiums. So yes, until next time.